Alrighty, so this is going to be the second part of learning the strat A to Z, and we'll just get right into it. So the table of contents for this video is we're going to go over actionable signals, what makes a signal actionable, and time frame continuity. Price has to trade in the direction of the most twos and twos going three. And then decoupling, so when things occur matters, and pivots, how to leverage broadening formations in your trading using pivots. So we'll just get right into actionable signals. So what makes a setup actionable? Actionable signal means that it's something we can trade off of, because not every reversal is an actionable signal. There are things we understand will increase the odds of the trade working out. So for example, on a 2-2 reversal to the upside, having a lower wick and a small body on top makes an actionable signal, and vice versa for the downside. So these are called hammer to the upside. So this is an example of a hammer right here. And you can see it is a 2 down that was red and failed that side and started going 3. Because we know if we fail one side of a range, we take out both sides. So we're likely to take out this side now. And shooter, which is the same thing. So it's a 2 up that failed, meaning it went from green to red and it's tried to come back through. And all it does is set up the reversals for you. And then there's also other candles. So this would be a, you could call it a spinning top, which this body would be a little bit lower for a spinning top, or a doji candle, which these are just marking indecision, because you can see it kind of just fought between this all day. So it's chop, chop, chop. And then finally they'll make a decision normally. So 2-2 reversal to the downside or continuation, depending on what this first the candle in front of this is. And same thing for a doji candle. So this is a doji. This would be a spinning top. Once again, if this body was just a slight bit lower, where we have a more topping wick, and then we have a hammer and we have a shooter. And you could still take 2-2s without hammers, shooters, dojis, or spinning tops. All these do is just kind of increase your odds, because we know that there's indecision, or we know that we're failing one side of the range. And we'll just get right on to the next thing then. So there's some more lingo when we're talking about setups, and we'll just kind of get into that in the actual signals part of this. So we have hammer, counter, shooter, and it's just a shooter candle followed by a hammer. So you can see we have a shooter and a hammer. And all that means is we came up here, trapped everyone long, and then they got stopped out. And then we came down here, trapped people short, and then they got stopped out. So all the market participants are just sitting on the sidelines like, what the heck is going on? And then normally you'll get the 2-2 back to the upside, and then that will be the actual move. And you'll see this happen a lot if you look at wedges on charts. The wedge will go to the upside, and then it'll come back to the downside and stop everyone out. And that's going to be what this would be on a higher time frame. And a good example of that would be Palantir, Palantir, however you say it, PLTR on the weekly or daily chart. And then we have a pivot machine gun, which is just 5 or more candles yet to make a new high, or 5 or more candles yet to make a new low. So you can see here, this didn't make a new high. So lower high, lower high, lower high, lower high, lower high, inside bar. They're going to have to make a decision. So it doesn't have to be an inside bar. It could be a hammer candle, or just a red, or I guess, yeah, or a hammer candle, a doji, whatever you want. And this is just something we would look to take back to the upside. We'll kind of get into that and why that works later into this video. Then we have the 1er, which is the 1-minute chart, the 5er, which is the 5-minute chart, 15er, which is the 15-minute chart, the 60, which is the 60-minute chart. And then when you're talking about setups, you can see, so if we have a 2-2 15er on Tesla, that'd be a 2-2 setup on the 15-minute for Tesla. And it's very, very simple and easy to type out. So you're going to see that if you're in my Discord or in Rob's room, you'll probably hear it. And all that's saying is just all this information kind of condensed, so it's quicker. And if you want an example of a pivot machine gun, that is linked right here, and that's the video I actually just posted recently. So we're going to get on to time frame continuity now. So price has to trade in the direction of the most twos and twos going 3. So what is time frame continuity? So when we talk about time frame continuity, we're normally referring to the monthly chart, the weekly chart, the daily chart, and the 60-minute chart. So all time frame continuity. So time frame continuity is achieved when all the major time frames, the ones listed up here, are green or red. When they're in disagreement, so let's say the daily is red, the weekly is green, the monthly is red, and the 60 is red, they're not in agreement. So you're going to have conflict, which is going to likely result in chop or sideways untradable price action. And this is not what you want to be trading. So when talking about time frame continuity, it's called FTFC, full time frame continuity, up or down. So Tesla 2215er, FTFC up, which means we're looking for upside plays on the 15er. And using the time frame continuity tells us what the market participants are doing by price and time, which is left out of many strategies. Because like we said previously, if you're looking at the daily chart and you see a head and shoulders and I go up to a monthly chart, I'm not going to see the head and shoulders. So you're not using all the time frames and you're leaving out a lot of information that is going to help you make higher probability trades. Since we know 70% of trading is done algorithmically, we then know what they're doing because you have to tell an algorithm for things. So this is where a lot of traders get it wrong. So they're going to say that I'm getting stopped out by the algos, or it's like evil robots trying to stop you out of your trades and take your money, which is completely false. And they'll say that because price will come down, hit their stop, which is likely at a very obvious pivot, which we'll get into in a little bit. Likely at an obvious pivot, take it out, and then rip back the other way, which is just a broadening formation because it comes up here. So let's say you enter, comes up here, then comes back down, and then rips right back through. That creates the broadening formation. So what are algorithms actually doing, and why can we pick it up with time frame continuity? So algorithms have to be told 4 things by a person. So what instrument do you want to trade? Which is, let's just say SPY. What do you want to do? Buy or sell? So are they going to be buying SPY or selling SPY? How do you want to do it? So by sitting on the bid, taking the offer, hitting the bid, etc. And you'll see when this is happening. So when do you want to do it? So when the 60-minute is the same color as all the larger time frames, they're doing it right now. So if the 60, daily, weekly, and monthly are all green, that means right now they're taking the offer, because in order to be above the open on all those time frames, the market participants that are the more aggressive have to be the buyers. So that's not something you want to be short. That's something you want to be buying with all the other buyers. Hopefully that makes sense. And it's the same thing for the downside. So if the 60, daily, weekly, and monthly are all red, then they're hitting the bid, they're aggressively selling, and we're under the open. So the only way that can occur is if market participants are selling by price and time. So monthly, weekly, daily, and 60-minute participants are all selling, which means they're doing it right now. So an example of time frame continuity to the upside. So this is actually the example from the video that I linked before for the pivot machine gun. And you can see, so we have the time frame continuity script, which is linked up here for Thinkorswim. And for people that said the links were not working, make a copy of the slideshow and then it should let you click this and get the link. But you can see we have this arrow marking time continuity to the upside. And if you look at all these charts, which this is the hourly, this is the daily, this is the weekly, and this is the monthly, on W, you can see the monthly went from red to green. So we know the month, on the month time frame, so monthly participants are aggressively buying now. On the weekly, we now have this hammer, which this is a 2 down hammer. So now we have a 2-2 reversal up into the green week, and then the day, which is 2-2 continuation day, into the green week and month. And now we have the 60-minute, which is outside bar, 3-2 continuation. We learned about that before. And that is going to be a 3-2 into the green day, week, and month. So we have time frame continuity to the upside. So hopefully that's a good example of how time frame continuity is used when trading. So you can see we took a weekly signal to the upside for the 2-2 reversal week using the hourly chart. So time frame continuity when volatility is high, which this isn't very important, but if you want to know it all, here it is. So when volatility is high, you would look to lower timeframes for continuity. This is because when you're making the average weekly move on the 60-minute chart, you're then given tons of opportunities. So this means, let's say the average weekly move on SPY, when we have a VIX of like 13 or 14, is $7 to $10. Now we have high volatility, and on the 60-minute, we're moving $7 to $10. We have tons of opportunities throughout the whole entire day then, because you can trade each 60-minute like a weekly candle. And the way you do that is you'd use the 60, the 30, the 15er, and the 5er for continuity instead of using the 60-day, week, and month. So that just gives you a smaller picture of the larger moves, which lets you kind of trade those moves intraday. And like I said, it's less important. It's not going to be of relevance anytime soon, in my opinion. So now we're going to get on to decoupling. So we gain more information as time progresses, and we also know that when things occur matters. So what is decoupling? Decoupling is when we get separate openings for each time frame. So it's when they separate, and it's something that is very important to pay attention to, and it goes like this. So when the new month opens, we then have a new week and a new day, which means on the first day of the month, we only understand or know what the monthly participants are doing. So this is because larger time frames take precedent over the smaller time frames. So when we look to take a monthly signal we would look to take monthly signals instead of daily or weekly signals, which does not mean those daily or weekly signals won't work. It just means that those are not in force. The things in force right now are just the monthly. On the second week of the month, the weekly participants, since on the second week of the month, now we have a separate open for the weekly, because during that whole first week, the monthly and weekly open are the exact same. So on the second week of the month, they're given a chance to negate the monthly open. So if we take out the previous week's low, that would be a reversal down into time frame continuity. So I don't have an example up here. I'm not sure. Let me see if I do have one. Yeah. So we have an example coming up. So just keep that there. And then on the second day of the week, and this is every week, the daily participants are given the chance to negate the weekly open. So turn the week from green to red or red to green. So taking out the previous day's high would flip the week, if it was a red day, to the upside. So it'd be negating Monday's open to go red to green, or vice versa. If we take the low, it'd be green to red. So since we know we gain more information with time, we then know to be cognizant of our entries falling back in on us if we enter on the first week of the month or first day of the week, because we might get a huge 2-up day, but if we gap against it and take out the low on the second day of the week, then that week could likely be 2 go 3, or it's just going to be chopping you up with an inside week. But many traders of the strat will go smaller size on Mondays and the first day of the week and let them open, which is just, you want to get the separate openings for all the time frames, which you get more information from. So an example, so this is on BA on the daily. So the top line right here, this is last week's high. Not sure why I put low, but this is last week's high. And you can see the middle line, this would be an entry short. And then this is last week's low. So you can see we were green, which this is I wouldn't say this is a good example of negating the open. This is just an example of the 2 going 3. So we were green on the month, or green on the week. But since this open right here for the week and day is so close to the current price action, it's not unlikely that we could come and reverse that week. So now we have the 2 go 3 because we took out last week's highs and then came red on the day. So this is on Monday, which means the day and the weekly candle have the same exact open. So now going into tomorrow, we have this 2 go 3, which means that we took out one side of the range and failed, and we're coming back in. So this would have been a shooter, but the head is very large, so it's just going to be a 2-2 reversal. But since we took out the high and we're going to negate that and go 2-2 to the downside, now we're going to look to take out last week's low, because we know price action takes out both sides of a range. So, and the beauty in this is if it was a weekly or monthly chart, it'd be... So I was actually going through and editing this video before I threw it up, and this is a good example of we know exactly what's going on. So you can see the day goes 2 up in bright green, and then it fails, goes red, starts coming back through the previous range. What do we know about price action? Takes out both sides of the range. So we have the high from last week and the low from last week. So we took out the high. What are we going to do? We're going to go red on the week, red on the month. I'll actually pull it up quick. You see red, 2-1 inside bar. two reversal month under 229.93, and that's full time frame continuity to the downside, right? I think it's like right around right here. So we're running full time frame continuity, 2 go 3 week. We know we're taking that out right there, and look exactly what we did. Gap, take that out, and now guess what? We're getting some more because that monthly magnitude is going to take out this right here, 213.85. So just a good example of, so you can get back to the rest of the video now. And we're going to go broadening formation. So how we use pivots in order to gauge magnitude and trade the broadening formations in real time during the day or week or month, however you're trading. So what is a pivot? A pivot is where people likely have their stops. And this is the pivot machine gun from earlier that we're going to talk about. So when looking at a pivot machine gun, you're going to notice there's 5 pivots to the upside that have not been hit. So I don't have the extra candle right in front of here, but we're going to act as if this is a lower high. So we have 1, 2, 3, 4, 5 lower highs. So all these pivots are just sitting here. Anyone that got short, actually, I'll just read this. So this means over the past 5 days, if we're looking at this as a daily chart, anyone that's short had no reason to exit their position. So we know they are still short. So any participants short in here, 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 or here, they're going to be having their stops at obvious pivots. So once we've identified this, we know to buy the first reversal into those pivots. When that occurs, you're going to be stopping people out while also having daily participants bid up the price, because if this is green, we know daily participants are buying. Let's say this was last week's close, or let's say this was last week's close, and then this was Monday. Now we know weekly and daily participants are buying. And when this occurs, you have people getting stopped out, bidding the price up, and removing liquidity, because if you have a stop, that's just gonna be a limit order. So you have, think of it as you have a limit buy here, a limit buy here, a limit buy here, and here, and here. So it should go right away and just rip straight through. And you also have buyers becoming aggressive, which it creates a large and quick move into those pivots. This is a great example of why we look to trade through a previous range, because going into all-time highs or all-time lows, which is the abbreviation here, means you're not stopping anyone out and you have exhaustion risk. And that does not mean we don't take stocks that are strongly going into all-time highs. It just means we'd prefer to take stocks that are not, stocks that are trading through a previous range. So this pivot machine gun, it worked the same way to the downside. So if we had a 2, 2, 2, 2, 2, 2, and then got a reversal to the downside, it's the same exact thing. And we look to trade through a previous range because most of the price action is going to occur there. That is quick and directional. Because when you're going into all-time highs, unless it's something like HD or Lowe's or Tesla or Roku, those huge runners that we all know about, it's going to be unlikely that you're going to be moving very quickly. So because you just don't have the people getting stopped out, you really have to have the buyers step up when they're going into all-time highs in order to keep price action to be moving quickly with larger ranges. So using pivots in your trading. So this is going to be a little bit brief because I'm going to have a full video dedicated to this when I have the time to. But we use pivots because every pivot we take out broadens the range we are trading through. And getting a reversal after taking out a previous pivot is a good heads up. We may turn around and go into the highs or higher. So you can see in the example, we take out the low of that mother bar, and all a mother bar is one that creates a compound inside bar, which we did talk about in the previous video, I believe. And that's just, yeah, like I said, a large bar that creates a compound inside bar. So inside, inside. So these are compound inside, and then we take out the low of that mother bar. And you can see now we get the inside bar, so they have to make a decision because we know from an inside bar it has to be a 2, no matter what. Eventually there has to be a 2. It could go triple inside and then 2, or quadruple, whatever. There has to be a 2 at some point. So you can see, you can eyeball the broadening formation that's about to occur. Since we know we took out the low of that mother bar and now we're reversing, we would then look to target the high of that mother bar to create the compound outside bar. So you can see we've made the slight lower low on this 2, and now we have the inside bar, 2, 1, 2 reversal, and we kind of have a pivot machine gun here. And our target would be to take out this, 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 and then this, which create the compound outside bar right there. And that's just an example. There's many other types of setups and ways you can do this. What I would suggest is going on the charts. So if you go onto like an hour chart, let me see. I don't think I have anything else here. So I'm actually going to exit out of this and pull up my charts here. So I would suggest going on to like an hourly chart or something that moves. So hold up. Let's think. Tesla. So since we know price takes out both sides of a range, we then know to be looking for broadening formation. So this was actually one that I did call out, which worked beautifully. And I think it was called out on Twitter by Sarah. So you can see all you have to do is you'd mark the previous highs and lows. So when we get this gap down, we know to be looking for broadening formations because now we have a pivot here and here. So we take out this and come back through. This is going to be the one we look to take out because you can see we have this mother bar. We take out slight lower low and then come back through. And if you mark the high, you can then see, take out the high, and then we come back through again and take out the low. And then we come back through and take out the high. And that creates your broadening formation that you can then draw. And we knew this one just from these 2 points. So 3 candles and we got the lower one. And then once we get this higher high, which you don't have to wait for the broadening formation to occur, you can just trade understanding that we take out both sides of a range. But now we get the higher high and we can draw it. So we come back down here, you get the 2-2 reversal, which you probably would have gotten stopped out on. And then we finally get this 2-2 reversal here, which takes us all the way back up to our magnitude, which is going to be this high as stated previously. And then we have this one and this one and that one. So you can see slightly higher high compared to all this, which is where you can try and redraw this if you'd like. So slight higher high, which is going to be really hard to see on here, but I zoom in, you can see slightly higher high just by a couple pennies, which people are going to be like, well, that's resistance. It's like, well, it broke it. So I wouldn't say that's really resistance, but so there you go. And then you get the 2-2 reversal back down, and this creates an inside of 4 hour, which actually was actionable, something you could have taken. So you can see inside 4 hour and down, and that was just today. So 2 1 2 to the downside into the broadening formation, and we get the range expansion, which just means that we're coming down to take out all these other pivots. And this is where you draw more pivots. So it'd be this one, and then this one, and then continue lower. And hopefully that kind of puts it into your head of what to be looking for. It takes a lot of practice to be realizing those, but a good way to start recognizing them is looking for these larger bars. That's on the hourly, it's going to look a bit larger. But if you look for that larger bars, the mother bars, those will likely be starting them. So you can see we have a 3 2 2. Didn't quite get it there, but we got it up here. So hopefully that helps you guys. All right, so this is going to be the end of the video, and we will get more into broadening formations and magnitudes into the next one, kind of in the putting it all together to actually trade it part of this series, which will be the 3rd video in it. And before we get to that, I want you to go over to my channel, hit subscribe, which you can't see it here, but hit subscribe, and then also you can check out all the other playlists that we have here, which you're going to see. We have Learning the Strat A to Z, which is the one that you're currently looking through, and we have the live trading playlists where we have all the replays from trading live throughout the day, and How to the Strat, which is where you're going to have more kind of informational stuff with trading it, trading it intraday. So hopefully that helps you guys. I'll try and get that video out as soon as possible. It'll probably be sometime this week if I'm able to do so. And that's going to be about it. So I will see you guys in the next video.